Listen closely because if you hold silver, what I'm about to explain is going to resonate on a deeper level. The market right now isn't simply nervous or unsettled. It is fundamentally rewiring itself, and most people still don't fully understand what that means. What we've just witnessed in the silver market was not a routine pullback or a normal correction. It was a combination of panic, forced positioning changes, large-scale technical selling, and shock waves that spread far beyond basic supply and demand. You've probably seen dramatic phrases in the headlines about failed emergency actions or system stress. Underneath those words, however, is something much more important: a real structural shift backed by data, not rumors. We are seeing forced selling from commodity index funds, mandatory rebalancing flows that are unloading tens of billions of dollars worth of metal, and price swings so aggressive that they are actively reshaping how liquidity behaves in silver markets. Just days ago, silver was pressing into levels above $80 an ounce, a price almost nobody would have confidently predicted a year earlier. Then, just as traders were expecting things to calm down, index rebalancing hit the market. This was not small profit-taking by individual traders. This was systematic selling driven by strict rules that govern how massive funds must reallocate capital at specific times. At the same time, this selling pressure landed on silver with particular force. Tens of billions of dollars worth of gold and silver positions were reduced aggressively, and because silver's market is much smaller and less liquid than gold's, even a few $billion of forced selling doesn't create a small dip. It creates an earthquake. Silver dropped more than 4% in a single day as funds unwound positions to meet those rebalancing requirements. But here's where things become more revealing. That rebalancing event, as chaotic as it looked, exposed something deeper about silver today. It showed just how fragile price dynamics really are, far more fragile than most investors realize, and far more sensitive to institutional mechanics than to pure supply and demand fundamentals alone. This is an important moment to pause, not to panic, but to get grounded. While bold headlines talk about silver racing toward $120 or beyond, the mechanics underneath suggest a market that is not only volatile but complex and unpredictable in ways that are actually more interesting than simple price targets. Yes, silver surged dramatically through 2025, reaching record highs and delivering historic gains. Industrial demand accelerated at a pace that surprised even longtime bulls, driven by solar energy, electric vehicles, and electronics. These sectors now account for a significant share of global silver consumption, and that is not hype, it is fundamental reality. Unlike gold, silver is not just a store of value, it is a critical input in modern technology. But that dual role, as both a precious metal and an industrial commodity, makes silver's price behavior jumpy, reactive, and sometimes brutally unforgiving. Now the picture becomes even more complex. Stories about China using silver as an economic lever are no longer easily dismissed. Recent export licensing changes have given China greater control over refined silver flows, reshaping global supply routes and tightening availability outside Asia. That means futures prices, ETF positioning, and physical flows are being influenced by policy decisions, not just by traders. Governments are increasingly treating metals as strategic resources, and that changes the entire game. On top of that, analysts at major banks are openly warning that extreme volatility is likely to persist, not because of emotion alone, but because of real physical shortages in specific regions and fragmented inventories sitting in locations that no longer influence benchmark pricing the way they used to. Silver may trade in the mid to high 70s today, but that price does not necessarily reflect how much metal exists globally. It reflects where that metal is, how accessible it is, and whether it can reach key pricing centers at the right time. When inventories are tight in London but heavy in US vaults, you get geographical mismatches that create price behavior most casual observers can't easily understand. Combine that with mechanical selling from index rebalancing, and you get a perfect storm where prices can plunge one session and spike the next, without any major news on inflation or interest rates. This isn't sentiment-driven chaos, it's infrastructure stress. Interest rate expectations only add another layer. Markets are constantly speculating about potential US rate cuts, which usually support precious metals, but those same expectations can trigger sharp sell-offs when data contradicts them, such as stronger employment numbers or rising bond yields. When one force pushes silver higher through industrial demand and geopolitical risk, while another pulls it lower through technical selling and macro adjustments, the result is raw volatility. And volatility is not just noise. For institutions, it creates opportunity. For everyday investors, it creates confusion. Liquidity is a key part of this story. Unlike larger markets, silver does not have deep order books that can absorb large trades without major price impact. Its relatively shallow liquidity means even modest flows from large players can amplify moves dramatically. This is why double-digit percentage moves in short time frames are no longer rare. When prices move that fast, stop-loss orders cascade, margin calls trigger, and forced selling accelerates well beyond what fundamentals alone would justify. Silver is no longer behaving like a simple commodity. It has become a highly leveraged, liquidity-sensitive asset. Not long ago, silver was dismissed as a sideshow compared to gold. That narrative has changed rapidly. Some institutional voices now argue that silver has entered a phase of true price discovery where values are no longer anchored to historical ranges. This is not a typical cyclical move. It is a structural reassessment of what silver is worth in a world defined by rising physical demand and policy-driven supply constraints. However, strong demand does not guarantee smooth price appreciation. Prices rise only when buyers and sellers align. When institutional rebalancing and technical selling remove buyers at critical levels, prices can fall sharply even in the face of real physical shortages. Behind the scenes, the stress is even more telling. Futures open interest has dropped sharply while volatility has increased, a rare combination that signals traders stepping back rather than betting confidently in either direction. Margin requirements have quietly tightened, making leverage positions uncomfortable and triggering forced liquidations without fanfare. Meanwhile, physical silver tells a different story. Premiums remain elevated, delivery delays persist, and some dealers hesitate to quote large sizes at all. That disconnect matters. It means price is no longer a clean signal. It is a negotiation. Globally, costs are rising again. Energy, freight, and mining inputs are not as cheap as some models assumed, which limits how quickly new supply can respond. At the same time, silver remains largely ignored in policy discussions. Gold gets the headlines and speeches, silver gets silence. Historically, that combination often leads to greater volatility, not less. Changes in trade flows, particularly from Asia, create what traders call ghost liquidity, where metal exists but not where pricing mechanisms expect it to be. When delivery suddenly matters, prices can move violently to reconcile that mismatch. Psychology now plays a central role. Markets are obsessed with timing rate cuts, interpreting every data point in conflicting ways. Silver reacts more sharply to uncertainty than gold ever does. Volatility itself becomes a constraint as large funds reduce exposure simply because risk models demand it. This creates a paradox where dramatic moves drive participants away, which in turn makes future moves even more extreme. What we are seeing is not a system collapse, but a system under strain. Participation thins, spreads widen, and price discovery becomes erratic. Round numbers like $120 become psychological anchors, shaping expectations and behavior long before fundamentals justify them. The danger isn't the number itself, but the way expectations harden around it. Some recent selling has not been bearish conviction, but risk management. Funds stepping aside because the swings are too violent, not because the story is broken. That distinction matters, because constraints can loosen just as quickly as they tighten. Right now, silver exists in a vacuum of conviction. Short-term traders are exhausted. Long-term holders are uneasy, but still holding. Institutions are cautious, not absent. Markets hate that kind of vacuum. Compression builds, correlations break down, and models stop working. Silver is no longer reliably tracking gold, the dollar, or equities. It is trading on its own internal stresses. Disagreement is peaking, and that is often when markets move the most. Volatility clears leverage, resets positioning, and forces structurally weak hands out. When that process ends, price does not drift, it snaps. The timing is nearly impossible to predict, which is why confidence is so dangerous here. Silver has a long history of humiliating certainty. It rewards humility, not arrogance. Yet something is undeniably different this time. Silver is no longer just about inflation hedges or industrial inputs. It is about trust in supply chains, pricing mechanisms, and the assumption that paper markets always align cleanly with physical reality. Fatigue is everywhere. Traders are tired of reacting, repositioning, and being reversed. That exhaustion slows action until suddenly it doesn't. When pressure finally finds an outlet, moves happen fast, often at inconvenient times, and rarely with clear explanations in the moment. Numbers like $120 represent scale, not destiny. They hint at how dramatic repricing could be when constraints ease unevenly and liquidity returns before stability. This is why the current moment feels unresolved and uncomfortable. Silver isn't giving clear answers yet. It's asking a hard question about how much stress modern markets can absorb before old assumptions fail. Markets answer questions decisively, usually when the fewest people are ready. If you feel uneasy, confused, or overwhelmed, that's not a weakness. It means you're paying attention. By the time the next move feels obvious, it will already be over. Uncertainty isn't a side effect here. It's the environment itself. And right now, that environment is not clearing. If you found this breakdown valuable and want deeper, disciplined insight into money, markets, and long-term thinking, make sure you subscribe to my YouTube channel, John Money Discipline. and stay connected for what comes next.